Welcome to our inaugural edition of Global Markets. Ongoing trade negotiations don't seem to be showing signs of a silver lining on the horizon. Our chief equity strategist and economist John Blank says we may just appear to be moving from one level of escalation to another. He's here now with me to discuss this further. With tariffs having become the watchword lately, John, at least with regard to Mexico and China, how concerned should investors be? Or is this just political theater to achieve an end?
Terry, I think people should be very concerned. And the reason is the Fed funds markets and the Federal Reserve System and, frankly, all the global central banks in the world are watching for more tariffs out of the U.S. and retaliation, tit for tat from China, even though Trump and Xi are going to meet at the G20. So basically everything's on watch, and it will be a sequence. It will be tariffing of consumer goods by the United States to 25% on the remaining $300 billion going to China or coming from China, and this will set off a 50 basis point cut from the Fed and a lot of other actions outside the United States.
So is that tit for tat a likely scenario that could unfold going forward, or are there others?
No, that's the most likely scenario is the straightforward tariff tit for tat. But there's always ongoing repercussions from the Chinese side that have to be thought through that will be entirely different. They've had a year and a half now to think this through. They also are lowering tariffs on incoming imports from other countries to China. So they are trying to broaden the appeal of the Chinese market for anyone other than the United States, which people also have is another front in this whole trade war.
So given the rising trade tensions, what do you see for the U.S. economy going into the second half of the year?
Terry, if you do a straight model result of GDP growth for the United States in 2019, the answer is somewhere between 2.8 or 3% for an annual growth rate. Now, what happens here to be the most successful forecaster on Bloomberg or something is you go ahead and shave that down for the tariffing or for anything else that you consider to be playing out. So bottom line is this administration is carving down on 3% growth rates and getting into a 2.5% scenario with their tariffing. And they're also carving down on record high profit margins with some of their tariffing. So it's not the all cylinders go model of economic growth. It's something much less than that.
Still regarding our economy, John, earlier this week, in fact, on June 17th, it was reported that a key manufacturing gauge, the Empire State Index, saw its biggest one-month decline in 18 months in this month of June. Also, the country's home builders, while reporting solid confidence in the housing market in June, showed levels dropping slightly due to concerns over these trade issues, the high costs of construction and the lack of skilled labor as well. Are these all warning signs?
Well, the warning signs are different things. The Empire State plunging is showing you that the goods momentum in the United States and the world is completely destroyed over the last 18 months. But you got to remember that goods production in the United States is 15 or 20% of the story, 80% of the services. So when you see these PMI numbers coming out of the Empire State or Chicago or anywhere else, you got to remember this is a manufacturing PRI, goods PRI. That's tariff related, not the services. The home builders are showing a different story, which is the high labor market and the cost of construction is we're seeing some overheating here. So this is a very different story, and that's the other part of what's going on here is you're trimming out the goods production from an overheated service and construction economy with very tight labor. So this is the context we're all operating in. Again, it's back to shaving down a 3% growth rate towards 2.5%.
So is there a broader global impact regarding these tariffs beyond the U.S., Mexico, and China that investors should be aware of?
Yeah, first of all, the Chinese story I'd already alluded to. They are cutting tariffs very modestly, but they're cutting them on anyone else who's bringing stuff into China. So this is the story of China trying to keep the rest of the world on its side. And the other point is that no matter what anybody does, the Mexican economy is in a bad situation and the one spot to watch most of all, because not only is it tariffing, it's also the uncertainty over the border and immigration that continues to roil the peso and the whole outlook for the Mexican economy, and that's where people need to focus on.
A little closer to home, what do you make of Fed action this week here in the U.S. to hold rates steady for now, but opening the door for a possible future cut?
That's pretty much what I think I had advised going in, and it's nothing to surprise me. I think Powell is telling you he will watch the tariffs. If there are no tariffing and success with Xi in a negotiation, then he's going to sit pat or even start to change his language in his outlook. And the other direction is if they do tariff on consumer goods, he's ready to go with rate cuts, and he's preempted the market with his language about that. So it's the bifurcated strategy of a situation that you don't have control of, but the Fed is not a gambler, which what that means is they will not move until they know what the tariff situation is.
Stocks on your radar currently include Air China, Molina Healthcare, and Anglo Gold Ashanti.
Right. These are three different names all tied into this story. Air China, obviously this is the biggest air carrier, flag carrier of China. The stock actually is in a really nice valuation pattern. And again, if you believe that this is going to work out and that China is going to start to see some acceleration and make a deal, you want to look into Air China. Molina Healthcare, this is an Obamacare HMO stock. The HMOs continue to hold up. This one has a nice momentum pattern. It's been a little bit of a pullback in the last few weeks, and you got to like the fact that you can stay out of the trade war story with a Molina Healthcare. So if you're a little more defensive, a little worried about this whole thing, go with Molina Healthcare. Anglo Gold Ashanti, ticker AU, which is obviously the gold ticker AU. The story here is people have, off the lows in early June to now, this thing has moved up 50%. And why that is that when people think there's going to be all this liquidity from the ECB and from the Fed and all these other places, there's worry about currency debasement and too much money floating around, printed money floating around, that gets the bid on the gold miners. And you're seeing this stock even today up 5.5%. So if you want to trade a stock on the worries over too much liquidity, go to ticker AU.
Chief Equity Strategist and Economist John Blank taking a look at the global markets with John. I'm Terry Ruffalo.